Good afternoon from New York. It's 1:21 p.m. on Friday, March 27th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The market is currently open and it is ugly out there heading into the weekend. Let's get right to it.
Ugly is the right word. Here's where we stand right now. The S&P 500 is at 6,419, down about 0.9%. The Nasdaq is at 21,129, off 1.3%, and now firmly in correction territory, more than 10% below its record. The Dow is at 45,510, down nearly 1%, and it joined the Nasdaq in correction territory this morning, 10% off its 52-week high. Russell 2000 down 1.1%. The VIX is at 29.64, essentially kissing 30, which it breached earlier this morning. The 10-year Treasury yield is sitting at 4.42%, up 45 basis points from 3.97 before the war started. The 2-year is at 3.61, giving us an 81 basis point positive spread, a normally shaped curve that is signaling something decidedly abnormal. This is a geopolitically driven risk-off regime with an oil supply shock at its center, and every asset class is repricing around it.
So let's start at the center. The Iran war, the Strait of Hormuz. What specifically changed this week that's driving the fresh leg down?
Two things converged. First, Iran's Islamic Revolutionary Corps effectively declared the Strait of Hormuz closed this morning. 2 Chinese vessels were physically turned away, and a Thai-flagged cargo ship was hit and ran aground. That's not a hypothetical risk anymore. It's an operational blockade of the waterway that carries roughly 20% of the world's oil. Second, Trump extended his deadline to strike Iranian power plants to April 6th, which sounds like de-escalation, but the market is reading it as the opposite. Citi's strategists put it well. Repeated deadline extensions by the U.S. are overall net negative for a resolution. Iran's foreign minister told state media Tehran has no intention of holding direct talks, and the Pentagon, according to the Wall Street Journal, is considering deploying another 10,000 troops. So you have a widening war, a physically disrupted oil choke point, and a diplomatic process that looks more like theater than progress. Brent crude is above $111 a barrel today, up from about $70 before the conflict began on February 28th. West Texas Intermediate is above $98. That's a 40+% spike in under a month.
And that oil move is rippling through everything. Walk us through the cross-asset reaction.
This is where the connections matter. Start with oil at $111 Brent. That feeds directly into inflation expectations. The University of Michigan one-year inflation outlook came in this morning at 3.8%, up 0.4 from February. That inflation impulse pushes bond sellers to demand more yield, which is why the 10-year has climbed from 3.97 to 4.42 in a month. That 45 basis point move in yields mechanically raises mortgage rates, auto loan rates, and corporate borrowing costs, which slows the real economy. And that's showing up. Consumer sentiment dropped to 53.3, down nearly 6% month over month. Now look at equities. Higher yields compress the present value of long-duration cash flows, which is why the Nasdaq, the longest duration index, is leading losses, down 1.3% today and over 10% from its high. Meta, ticker META, is down almost 19% year-to-date. Microsoft, ticker MSFT, is down 24%. On the other side of the ledger, gold miners like Newmont, ticker NEM, are up 3.6% today, and crude oil futures are the top gainer in our movers screen at plus 5.4%. The energy sector has 100% of its constituents above both the 50-day and 200-day moving averages. That's a perfect score. No other sector comes close. Meanwhile, the dollar is strengthening as a safe haven, which further pressures emerging markets and commodity importers. So the causal chain runs Hormuz blockade pushes oil above $111, which spikes inflation expectations to 3.8%, which drives the 10-year to 4.42, which raises mortgage rates and borrowing costs, which depresses consumer confidence and compresses equity valuations, particularly in tech and consumer discretionary. That is the regime we're living in.
That's a striking number, the 10-year up 45 basis points in a month off a war shock. So what does this mean for the Fed? Because the rate cut narrative that opened the year is clearly dead.
It's not just dead, it's potentially reversing. Here's the headline. According to the CME FedWatch tool, the probability of a Fed rate hike by year-end crossed 52% this morning, the first time it has ever breached the 50% threshold in this cycle. That is a seismic shift. Coming into 2026, the market was pricing in multiple cuts. The Fed's own March dot plot still showed one cut this year, but the data is boxing them in. The OECD raised the U.S. inflation forecast to 4.2%, well above the Fed's own 2.7% projection. Import prices jumped 1.3% in February, the largest monthly increase since March 2022. So what was a rate cut narrative 2 months ago has completely flipped. The base case among the FOMC, according to Vice Chair Jefferson's speech Thursday, is to hold and watch. He explicitly said the current stance is well positioned to respond to a range of outcomes. But here's the tension. If energy-driven inflation starts bleeding into core measures, or if inflation expectations de-anchor, the 5-year Michigan reading held at 3.2%, so we're not there yet, then the Fed faces a classic stagflation trap. They can't cut into rising inflation, and they won't want to hike into a weakening consumer. The April 28th meeting will almost certainly be a hold, with just a 6.2% implied probability of a hike. But the trajectory has changed. The next move, if one comes, is now more likely to be a hike than a cut. That is new.
So who are the clear winners and losers from today?
Let me break this down cyclically and structurally. Cyclical winners, upstream energy producers like Occidental Petroleum, ticker XOY, which hit a 52-week high this week. When Brent is above $110, these companies are generating enormous free cash flow. Refiners like Phillips 66, ticker PSX, which rose 1.5% even on yesterday's broad sell-off, because crack spreads widen in supply-constrained environments. And gold miners, Newmont, up 3.6% today, because gold benefits from inflation hedging and geopolitical fear. Structural winners, utilities, particularly those with data center exposure, like Entergy, ticker ENTR, up 5.3% today, and Vistra, ticker VSTR, up 3.4%. They benefit from the AI infrastructure build-out and are defensive in risk-off environments. 77% of utility stocks are above their 50-day moving average. Also, structurally, consumer defensive names like Campbell's, ticker CPB, up 5%, and McCormick, up 3.4%. These are the stocks that outperform when consumers trade down and spending shifts to essentials over discretionary goods.
Now the losers, cyclical losers. Big tech broadly, especially the Magnificent Seven names with high capital expenditure commitments and long-duration valuations. Meta is down 12% in just 5 days. Amazon, ticker AMZN, is down 2.6% today, and Microsoft has lost 24% year-to-date. Rising yields and an uncertain consumer directly compress their multiples. Cybersecurity stocks are an acute cyclical loser today. CrowdStrike and Palo Alto Networks both down 7% on the Anthropic Mythos model report, which raised fears of AI-driven disruption to the security value chain. Structural losers, consumer discretionary names facing a pincer of higher energy costs, squeezing household budgets, and rising rates squeezing borrowing. Airbnb, ticker ABNB, down 4%. Travel and leisure names face both demand destruction from the consumer and direct exposure to Middle East disruption. Luxury stocks have lost $100 billion in market cap this month, with LVMH and Hermes each down more than $40 billion. And real estate is a structural loser. 45% of REIT constituents are near their 52-week lows, crushed by the yield backup. The one nuance, if oil collapses on a surprise ceasefire, big tech would snap back violently given how oversold it is. But absent that catalyst, the fundamental pressure is downward.
That's helpful, and it highlights how dependent the entire market outlook is on one variable, which is the war. Let me ask you about the corporate signals that are still cutting through the noise here.
Two worth noting, both connected to the macro story. First, Meta boosted its El Paso AI data center investment from $1.5 billion to $10 billion, a six-fold increase. That's happening even as the stock is down nearly 19% year-to-date, and the company is cutting hundreds of jobs across Facebook, global ops, recruiting, and VR. The message is clear: hyperscalers are not flinching on AI capex. Meta guided to up to $135 billion in capital expenditures for 2026. That spend is why utilities with power exposure are working. It's a structural demand story that persists regardless of the war. The second signal is Sony hiking PS5 prices by up to $150, explicitly citing memory costs driven by AI data center demand. That's the supply-side inflation story in a microcosm. AI demand is competing for components, pushing costs into consumer electronics. Netflix raising prices on all tiers is the same pattern, companies passing through costs because they can, while they can. These are leading indicators of a broadening inflation impulse beyond energy, which is exactly what the Fed is watching for.
What's the risk case investors should be stress testing this weekend?
Let me give you both sides with numbers. Base case, the Hormuz blockade remains partial. Diplomacy produces some framework by mid-April. Brent settles between $95 and $105. The 10-year yield stabilizes around 4.3 to 4.5%, and the S&P 500 finds support in the 6,200 to 6,400 range, roughly where we are now. The Fed holds through June. Consumer spending slows but doesn't collapse because the labor market, while softening, hasn't broken. University of Michigan expectations at 51.7 suggest caution, not panic. In this scenario, we grind sideways with elevated volatility through the second quarter. Risk case: Iran escalates the Hormuz closure to a full military blockade, physically interdicting tanker traffic. In that scenario, Brent could spike to $130 to $140. That level would push national average gasoline prices toward $5.50 to $6 a gallon, which historically has correlated with recessionary consumer behavior. The 10-year yield could breach 4.75% as inflation expectations de-anchor. Remember, the 5-year Michigan expectation is at 3.2, and if that starts climbing toward 4, the Fed has to act. In that world, the S&P 500 could correct another 8 to 12% from current levels, putting it in the 5,700 to 5,900 range. Small caps would be hit hardest. The Russell is already down over 1% today, and Citi just zeroed out its small cap overweight. The sectors most exposed would be consumer discretionary, which could see 15 to 20% drawdowns, and financials, where only 1.4% of constituents are above their 50-day moving average, signaling a sector already on the edge. Moody's Analytics already puts recession probability near 50%, Goldman at 30%. A sustained Brent above $125 would likely push those consensus numbers above 60.
So, given all of that, how should investors actually be positioning right now?
Highest conviction: energy producers, specifically integrated majors and upstream names with strong balance sheets, immediately increase exposure. This is the one sector with perfect technical breadth and a fundamental catalyst that only worsens in the risk case. Secondary conviction: utilities with power AI demand exposure, Entergy, Vistra, American Electric Power. Maintain and gradually increase over the next quarter. These work in both scenarios. They're defensive in a downturn and benefit structurally from data center build-out. Tactical hedge, gold and gold miners. Newmont at $102 is a clean expression of inflation hedging and geopolitical risk premium. Also, consider short-duration Treasury exposure. The 2-year at 3.61 offers yield without the duration risk that's punishing the long end. Core allocation should be shifting away from growth and toward value and income. Avoid rate-sensitive consumer discretionary, high-multiple unprofitable tech, and REITs. These are the sectors with the most negative skew in both scenarios. And reduce exposure to magnificent 7 names that have become pure duration bets in a rising rate environment. Microsoft down 24% year-to-date, Meta down 19%. The only exception within that group is Apple, which has held up relatively well with just a 7% year-to-date decline and a much lower capex profile.
How does it all fit together?
When you step back, this is really about one thing: a supply-driven energy shock repricing the entire macro landscape, from inflation expectations to the Fed's reaction function to corporate margins to consumer spending power, all at a moment when the economy was already showing fatigue from tariffs and prior tightening. The cross-asset picture is internally consistent: oil up, yields up, equities down, volatility up, defensives outperforming cyclicals. That coherence actually tells you the market is functioning rationally. This isn't a liquidity crisis or a disorderly sell-off. It's a methodical repricing of risk around a single variable, the duration and severity of the Iran conflict. And that makes the April 6th deadline, Trump's extended timeline for potential strikes on Iranian energy infrastructure, the most important date on any portfolio manager's calendar.
Give us 3 takeaways to carry into the weekend.
1. The risk. Fed funds futures now price a 52% probability of a rate hike by year-end. That is a regime change in expectations, and any further evidence of inflation pass-through from energy into core prices could accelerate it. 2. The market insight. The Dow entering correction territory today means all 3 major indices are now 10% or more off their highs, with the S&P on pace for its longest weekly losing streak since May 2022. Breadth is collapsing in financials, tech, and real estate. This is not a narrow sell-off, it's broad-based deterioration. 3. The positioning idea. The energy to utility barbell is the trade that works across scenarios. Energy captures the upside of sustained conflict and elevated crude. Utilities provide defense plus structural AI demand. Together, they give you inflation protection and income in a market that desperately needs both.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.